On today's Hashi, I'm discussing the Fed meeting, Powell's statements on housing yesterday during the Q&A, and pending home sales for September. Today is Thursday, October 30, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Naples, Florida, wherever you may be, it's a pleasure to be with you. Let me know in the live chat where you are tuning in from this morning on Jerome Powell Day. Did he just ruin mortgage rates? That's the big question. He has a lot to do with what the expectations are in the future, if not the majority of the expectations were sitting on his shoulders yesterday. And of course, when he took to Q&A, a lot of things changed within minutes. We saw a 10-year adjust. We saw a 30-year fixed adjust. I was going back and forth with somebody in the DMs on IG. Rarely respond to DMs, but the takes from this person are just so crazy. Like, see, a week later, I told you that inflation report was going to pop up. No, we had the report last week. Inflation, in fact, the investors, the market feels good about it. I mean, that was obvious over the last 7 days. Dow hits an all-time high. 10-year gets into an under 4 spot. And the investors are starting to say, hey, this cut's priced in. Should we start pricing in December's cut? See, that's what they do. The investors, the market prices in to the future. Okay. And no, don't price anything in yet. There's a lack of a plan. I'll explain it more. And that's why we saw what we saw yesterday. That's why we saw the 10-year and the 30-year react. Very little to do with an actual positive, better than expectation report on inflation just a week ago. Okay, so if you're getting caught up, Federal Reserve, their press release, they had the meeting, and they suggest that activity here in the economy has been expanding at a moderate pace. Okay, so that's the first line of the prepared statements from your Federal Reserve. Not only yours, but maybe the world's Federal Reserve. The world is kind of hinging on what some of these decisions are going to be made by Jerome Powell and the Fed. Job gains have slowed this year, and unemployment rate has edged up but remained low through August. Now, okay, through August. Notice that. Through August. Yeah, it remained relatively low for sure, historically speaking, through August. It's like it's Halloween tomorrow. Jay Powell, what are you going to be? What are you dressing up as tomorrow? Pinocchio? Because a lot of the stuff that you say doesn't make a lot of sense, okay? Now, you have data through August because now we've been living through this government shutdown, which continues to just get extended for seemingly not a lot of good reasons. Like, everybody who's struggling due to the shutdown, we talked about some of the real estate struggles yesterday, it could all be avoided, and then Congress could go back to DC and get to work. Like, both sides of the aisle are just being silly on this deal. The government shutdown now stacking up and nearing what will break the longest on record of 35 days. I believe we're only 5 or 6 days away from breaking that record. It seems like that will happen, or we're going to be the second longest shutdown in history. But we don't have this unemployment data, which is why in the prepared statements it says through August. More recent indicators are consistent with these developments. I mean, recent indicators from this week would suggest that unemployment could go higher. Okay, we heard from Amazon this week. We heard from UPS this week. Like, the job market is now turning into, a soft job market to potentially a job market that is seeing layoffs. My take on Amazon having their biggest layoff, listen, Amazon's got 1.5 million plus employees. Laying off 30,000 is probably good business. Could you find 30,000 out of 1.5 million that probably are just unneeded at this time? And they're obviously implementing a ton of AI. They're a tech company, and I get all of that. But does Amazon going out there and the headline reading biggest, layoff in company history, job reduction in company history, give cover to other companies to say, hey, we were thinking about, we might have to make a decision in 90 days if things don't turn out for us in the right way. If the Fed wants to be hawkish and pivot momentum, we may have to make a decision in 90 days. Do we make that decision now because Amazon just gave us cover because they're the biggest name and we can kind of slip under the headline radar? Yeah, I think that's a possibility. Okay. Committee obviously seeks to achieve their maximum employment and inflation. They are mandated by Congress to achieve maximum employment and inflation at the rate of 2% over the longer run. 2% is a made-up number. Somebody from New Zealand, that's where we're getting our information from decades ago on this 2% number. Go figure that one out. Uncertainty about the economic outlook remains elevated. Maximum employment really is going to be the thing that drives it. It's driving cuts now. The committee is attentive to both the risks to both sides of its dual mandate, and they're in a tough spot right now because inflation could start to tick up the more you start to address the maximum employment. Kind of stuck in the middle as they continue to potentially lower rates. They did that here on this meeting, and they reduced by the 0.25 percentage point to 3 3/4 to 4% as the federal funds target rate. The federal funds rate is not mortgage rates. The federal funds rate is the overnight borrowing rate. Huge impact for small businesses and the like. The 10-year reacts to what the Fed is going to do to rates in the future. There's certainly a reaction. We saw that reaction yesterday. We'll go through that reaction along with all of Jay Powell's commentary on housing. We've pulled the entire transcript. We have it all here ready to go. There was multiple mentions that are in relation to housing for real estate professionals. So we've got all of that information here for you. Okay. So here's the vote. When they voted, they had a 10-2 decision. Okay. So you've got 12 voting members of the FOMC. And they voted 10-2 to cut this benchmark rate to the 3.75 to the 4% target. And they will end QT on December 1st. Okay, so quantitative tightening is ending on December 1st. Okay, so Powell warned that another rate cut in December is not a foregone conclusion, as many, including Polymarket, had at a 90-something% chance. And many of the investors were counting on this. It's why you saw a pivot on the 10-year. It's why you saw a pivot on the 30-year within minutes yesterday of Jerome Powell saying, once again, I lack a plan. I have no idea what we're doing in December. I can't even begin to think about what December might look like. I'm just flying by the seat of my pants, much like I did 3+ years ago, when I told you and gaslit you and dragged you on AstroTurf and told you it was real grass to believe that inflation was transitory, because my post wasn't secured yet. But 8 days after Joe Biden secured my post, President Biden, I then decided inflation was real because my post was secured. Yes, I Jerome Powell, made a political move. I dressed up during Halloween as a Washington D.C. Loyalist, and I did whatever it took to get my post. That's exactly what happened, and it lacked self-awareness. It lacked objectiveness. It lacked common sense. it lacked intelligence when Jerome Powell was telling everybody, including Congress, when he convinced both sides of the aisle to print all that money. Remember that $2.3 trillion that kind of kicked off the new administration at the time? He was the one telling us, no, inflation, hey, transitory, not a big deal. Not when it was obvious, when it was skyrocketing and then infused by all that cash that they were printing. Now this is the same guy telling us, gee, can't figure this thing out. Don't know which way to go. Not sure about December. And the market doesn't like that. Market likes certainty. I don't know about you. I don't know about your business, but you like people who are certain, attention to detail, precise, that are exact with the objectives that they're carrying out. I like exactness, and I certainly like precision and confidence, and this is the direction we're going. These are the steps that we need to take. We're not going to continue to repeat false steps. We're just going to hammer home forward on the plan. We have a plan. And if we make a mistake, we're not going to make it twice. Jerome Powell continues to make the same mistakes. So they come out with their prepared statements. It's a 10-2 vote, which is interesting because they don't have many dissents. Remember, just recently we saw the first dissent in many years, but we saw 2 dissents here. Okay, so Governor Stephen Moran dissented, preferring a 50 basis point cut. Okay, so a half point cut is what Stephen Moran wanted. Now, Governor Stephen Moran is a President Trump appointee. Remember, there was a spot open on the FOMC. Trump appoints him, so he's a supporter of Trump. Trump wants lower rates. He goes, knowing that this thing's going to go 25 basis point cut. He goes, let me get a headline here, Moran says. Let me get some, maybe Trump leave me out a couple bags of McDonald's as a thank you in the Oval Office. Let me get a little brownie points. Let me get the Happy Meal with the brownie in it from President Trump because I go 50 basis, but not saying I don't, agree with a 50 basis point cut here. If you're not going to do a cut in December, I certainly would support that. But he dissents, goes 50. And then you have Kansas City Fed President Jeffrey Schmid dissented but preferred no cut. So little bit of politics here, by the way. Okay. Oh, the Fed doesn't do politics. Well, they play games, which is the same thing as politicking. Okay. Schmid says, oh, I know Moran's going to go 50. I'm going to kind of, I'll dissent too. I'll play the game and go 0 to kind of wash that out. And then 10 of you go ahead and vote this 25 basis point cut in. Fed usually likes to be aligned. There's cracks in the Fed right now. And you could say that the Fed is politicized. This isn't something internal that's happening. This is something from the head of the Fed. Okay. I pointed it out earlier. When you wait until the president of the United States, in this case, it was Joe Biden, gives you your reappointment, when you wait until that moment to recognize what's happening with inflation, you, Jay Powell, are politicking for yourself. Now, I get it. People look out for themselves. But to say the Fed is, insulated from politics, or the Supreme Court is insulated, everything is wrapped up into politics now. Unfortunately, that's the way it is. There's no purity anymore. And that's just the way it is. So, the Fed is playing politics with your economy. It's clear. And people who want to live in la la land and just pretend that everything is gumdrops and lollipops, they'll say to me online, they'll say, hey, Byron, you bad person, you shouldn't say that the Fed is playing politics. That's not right. They're doing the best they can. No, they're playing politics, looking out for their pocket, looking out for themselves. Fed ends quantitative easing on December 1st. QT had reduced the balance sheet by $2.3 trillion, bringing it down to $6.6 trillion. Okay, so ending QT on December 1st can help. During QT, the Fed allowed securities to roll off instead of reinvesting the proceeds. The balance sheet had expanded from just over 4 trillion to nearly 9 trillion during COVID. So down to 6.6. They're going to end the tightening, quantitative tightening phase. And maybe that helps the spread between like what we're looking at 10-year and 30-year remains to be seen. All right. So that's the prepared statements. Let's get into the Q&A when this thing really got messed up. And he has his prepared statements that he comes out with Q&A. It's roughly kind of what I went through there, sprinkled in a little bit of my own thoughts. And now let's go to the press conference. Okay. It didn't take long. His opening statement, he mentioned housing once. It was 2 minutes in. Data available prior to the shutdown show that growth in economic activity may be somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. This has been in his prepared statements now for multiple meetings. While activity in the housing sector remains weak. It remains weak because of the suffocation of your rate policy, Mr. Jerome Powell. Now, we know, as we saw last week, as just kind of some real-time data, as those rates get closer to 6, and we had momentum if Jerome Powell stamped it, where we could have been high 5s on the 30-year fixed going into this end of this year, next year, and into the spring market. We know that opens up the door for more real estate activity. Fannie Mae's projecting 9.5+% of existing home sales next year. We've been at 4 million for 3 years straight. We're in a real estate recession. Okay. The real estate recession, unless real estate opens up and people can start, transacting at a higher level again, you can forget about ever solving the problem of affordability. This lock-in is only exacerbating unaffordability. So it's his policy. It's where rates are right now, which is why there is a weak housing sector. And you're not going to see housing kind of really get going substantially versus what we've seen the last 3 years without some kind of help on the rates. All right. Q&A. We had a Janelle, I believe, Marty from Bloomberg, about 21 minutes in, asked the first question that I noted here, and they're talking about CPI. There's a little bit of an answer that weaves into housing, and we've been talking about CPI all week because some people get very confused by that report. Let's go to the question and the answer.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the 3 components.
Right
so
there.
Basically, you've.
It was a little bit softer than expected. CPI, it beat expectations. And there's a whole bunch of people running the other direction claiming that inflation is not in a good spot. The investors don't believe that. And Jerome Powell just acknowledged right there. We can go back to Jay, but go ahead.
Seeing goods prices increasing, and that's really due to tariffs, and that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that just We kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways
All right.
over the last few months. But
So what did he just say there about housing services? He says, remember, a couple of years ago, we said that it's going to get there and it's going to take a year, 2 years is what they said a couple of years ago about housing services. Why? If you go back a couple of years ago, you go back into the hot sheet show notes. All of our show notes from every single show are in school. You can go grab them. BMX members can know where they're at. Why a couple of years ago did they say, oh, it'll take a couple of years for this housing service to come down? Because that's how long the data lags that's in the CPI on housing. Realtor.com's been reporting for 26, 28 straight months that rent prices are coming down. We've had real-time data for 24, 26 months, but we've been reacting to lagging data, and we've had old data for 2 years. Now he's like, oh, yeah, it's here. And guess what he says? It's going to continue. Shelter is going to continue to move down. Jerome Powell saying, hey, shelter is going to continue to move down in the future, which means inflation is going to continue to get better. So why does he know that? Because he knows, looking back on the last 2 years, the data's been good on shelter inflation. Okay? Look at rent prices, obviously compared to purchase prices. The Fed, Jerome Powell, doesn't care if anybody ever owns a house. Okay? And rent prices have come down, and that is going to continue to show up in inflation, and you are going to see lower inflation based on that, and he's acknowledging it there into the winter. All right, let's go. He had a follow-up question there, but I'd rather go to Chris Rugaber from AP, and if we can get into his AI question, I think that's it. That's an interesting one there. If Haley, if you have that one ready.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
All right, so getting into some of the places that they're pulling data from right now, ADP data. They mentioned the Beige Book, obviously there. Beige Book, the last release of the Beige Book, we have it. That Beige Book came in, we had October, so we have one this, we have one from this month, okay, the Beige Book, okay, summary of commentary of current economic conditions. Now, the only thing I don't love about this, you get commentary from, you can see here, you know, who inputs data into the Beige Book. It's all the Fed Reserve banks, Boston, New York, Philly, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, KC, Dallas, and San Francisco. But they're really putting in, it's kind of like a rear view mirror look and then all their projections of what they think is going to happen. What is the Beige Book? It's a Federal Reserve System publication about current economic conditions across 12 Federal Reserve districts. It characterizes regional economic conditions and prospects based on a variety of mostly qualitative information gathered directly from each district's sources. Reports are published 8 times per year. So we got this publication in October. He's saying mid-cycle, so that means the next one is going to come out between now and that December meeting, which is 6 weeks from now. So I guess we get the next Beige Book in 3 or 4 weeks. Okay, so listen, I mean, I'd rather go on what Realtor. Honestly, I'd rather go on what Realtor.com, CoStar, Zillow, you know, Cotality. I'd rather go on these sources when it comes to shelter than what these Federal Reserves, you know, the St. Louis Federal Reserve thinks about the future of shelter. Like that's just, I want the technology companies that have the most data on this stuff, real time, fast, accurate data. Like that's what I want. And compare those 4 or 5 sources versus each other and make draw some type of projections from that. Okay, not the Federal Reserve members of Dallas, like cool, but it's, you know, it's not really what I want to be based decisions. And I certainly don't want it off the owner's equivalent rent, which is the government data in the CPI, and it makes up over 1/4 of inflation. Owner's equivalent rent is the silliest. Wall Street Journal, we covered that story, went through that story from the Wall Street Journal like over a year ago. Wall Street Journal's like, owner's equivalent rent is silly. It's dumb. It's this made up survey from the 80s. And it's just not relevant today. It's why the information comes in, you know, one of the reasons why a lot of the information that we have is 2 years out on this. So, they're trying, is what he's telling us. We're trying to get data from a lot of different sources. We get it from a lot of different sources. He mentions 2 or 3 there, but doesn't give up the other sources. Is very vague every time he's asked about, hey, where are you getting your information? Oh, a lot of different places. You wouldn't believe the amount of places we're getting information from. Okay. So Howard Schneider kind of followed up on this from Reuters. And why don't we go to that, and then we're going to go to another question here.
Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
You know, this is a temporary state of affairs, and you know, we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that you know, what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say, we really can't see, so let's slow down.
I mean, he said it right
As a
there. He's
follow-up
told
to
you
the
everything.
debate on this meeting.
You can cut, and then go to that. We'll finish with that credit question in a second here, Haley. Go to the 53-minute mark. Jennifer Schonberger from Yahoo has a question about credit, which I thought was interesting. So he told you everything right there about his plan. He can't see what's going on. He believes he's in the fog, and he's just going to slow down. And that's a signal he's made to the market. I don't know if I'm going up, down, left, or right. I don't know if I'm cutting, increasing, or easing. I've got no idea what I'm doing currently at this moment as your Fed chairman. It is too foggy. I cannot make a decision. He told you everything. We are slowing down. My goal is to slow down and do nothing and hope that inaction is the right decision. He's probably got a 33% chance that it is the right decision. I mean, that's about your odds on the roulette table. Roulette can be exhilarating, and it can end very fast and very disappointing as well. Jennifer Schonberger from Yahoo Finance talking about some losses from regional banks. Interesting. We had a conversation with Barry Habib on some different loans, like adjustable mortgage he wants to come see in. So these are some more risky loans in the auto loan, and what kind of implications is it going to have for credit. I think it's just interesting questions, so I included it in here. Let's go to Jennifer Schonberger.
Chair Powell, Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately.
All right. So Jay Powell just told you he can't see because it's too foggy, but he did say there, to kind of finish off, he does not see any credit risks, and he continues to make take the position that these regional banks are fine, right? We know that we a few years ago had a regional bank, a couple of years ago anyways, regional bank scare. Does not see that right now. So he must have at least one viewpoint through the fog of something he can see. He doesn't see regional banks having an issue today. All right, pending home sales. We'll wait another 6 weeks till we get Jerome Powell. The odds on Poly market came way down too, by the way. We were at near 95% that we'll get a cut. It's 70% chance. So I guess the better. I mean, I like this. Gives me hope, actually. Poly market gives me hope. Jerome Powell gives me little. But Poly market saying, hey, we're going to put our money 70% chance. There's still going to be a 25 basis point cut when we get here in 40 days, 40 days from today on the next meeting decision. Odds have come down considerably, but 70% still pretty strong. All right. Pending home sales. We saw a little pop last week. What did September look like? NAR's got the data out for September. September shows no change on pending home sales. Okay, no change from what? Okay, year over year, we're at a 0.9% decrease in pending home sales. Okay, so 0.9% decrease year over year. Pending home sale, we've seen like Altos research and some, I won't call it anecdotal, but some, week to week evidence that pending home sales is recovering. According to NAR, when you look at the year over year, we're basically moving sideways at the 0.9% reduction here. The US index is coming in at 74.8 on a scale of 100. 100 is activity on pending home sales relative to 2001. We had less population than in 2001 than we do now, but we more importantly had less age-ready home buyers in 2001. 2001 was not like what 2004 and 5 were as part of that mortgage crisis. 2001 was kind of just, somewhat normal. Okay. And 2001 would equal 100. Well, today, based off of that scale, that index, we're at a 74.8 month over month. We're just 0% up or down. So just completely flat month over month on pending home sales for September. Lawrence Yoon says we're at a 5-year high on inventory, giving home buyers more options and room for price negotiation. That quote there cost members approximately $75,000. And the West has the lowest score, 59.2 on a scale of 100. Month over month, pending home sales down 0.2% in the West. The Northeast at 65.7 on the scale, up 3.1% month over month. Northeast could have a healthier score with some inventory help. The least inventory happens to be in that region. Midwest is at 73.8, 3.4% month over month drop on pending. And the South, still, hey, say what you want about education in the South. They've got the highest grade score here on pending home sales. By the way, I think the education's great in the South, so I'm not taking a shot. South comes in at 90 month over month, 1.1%. Is the move up in the South. So where there's a ton of inventory and it feels like sellers have downward pressure on their price, pending home sales are performing better in that region, which includes Florida and Texas, some of the biggest inventory states, versus any of the other regions. So South performing at a 90 on this pending home sale metric. No change month over month, really no change when you look year over year, a 0.9% decline. So some of these changes that we've seen here, or some of this momentum that we've seen recently, and even in the past week, not necessarily showing up in the annual data. Here's your, and that's really it. I mean, that's it on the pending home sales. We're going to continue to watch that. I think some of the momentum that we might have had going into the end of the year just got sprayed down by the maybe Jerome Powell is going to be a firefighter for Halloween because he just took the hose to all the momentum that we had on rates. 10-year jumped up as Jerome Powell was letting loose on the Q&A, 4.099, basically 4.1. Okay, if we look at the last 90 days, that's definitely a jump up from the lower levels that we've experienced. It's almost near the high mark of the last 30 days where we've seen real momentum leading into the meeting. The markets were kind of pricing in a December cut. Now they're pulling back on that. I'd even say that the markets were pricing in a December cut. And that's where you're seeing the pullback. 10-year moving up. 30-year jumped up yesterday from 6.13 to 6.27. We've seen these swings almost every time Jerome Powell gets up there and does a little yak on himself, which is what happened yesterday. 6.27 off of the 6.13 tying the year-to-date low the day before. We saw the same exact thing last time Jerome Powell came up and created uncertainty about the future and uncertainty about any plan that the Fed has. With that uncertainty, the market has reacted, and now you're going to probably be dealing with a month now of rates that are not getting momentum towards low 6, high 5 handle. All right. If you want like-minded people to help you build your business, BAMX community, jump in. Listen, I know a lot of managers are focused on hitting their recruiting bonus this year. And you just feel like you don't have that community, that support, jump into BAMX. We're all working together. And every single week, if you don't know what to post, when to post, we deliver new content directly to you, hyper local content each and every single week, multiple posts from the BAM team who's creating all of the BAM content, creating content for you. This is all customizable to you. All of that content here inside of the Classroom, new this week Classroom, as well as hot sheet content each and every single week, every single day. All of the slides that we use here in the hot sheet and the hot sheet show notes available for you each and every single day in the hot sheet Classroom, as well as all of our masterminds that are happening, like our role play mastermind every single Tuesday right before hot sheet, 9 a.m. Eastern, help you convert on more deals. If you want to ultimately generate more leads, build a brand, and convert at a higher level, join the #1 community helping agents close more deals, which is BAMX. Go to school.com/BAMX to jump into that and get access to all of the benefits mentioned, as well as Zudelio, $2,400 value for free, included in your BAMX. You can try BAMX for free. Open it up for 7 days, 7-day trial by hitting the link down below. All right. That's your hot sheet for the week. There's your Jerome Powell day. Went a little long here today, but when Jerome Powell's given us all kinds of misdirections, there's a lot to break down. We'll be back next week. There'll be a Knowledge Brokers pod up new on Knowledge Brokers channel tomorrow. Walkthrough on this channel. Check out the Michael Valdez interview I did as well. Did that in Denver at the Fusion Rally. And shout out to James Becker. I saw him in the chat earlier who was able to set that up, and I have a conversation coming out with him next week, CEO of Fusion. And really looking forward to joining you guys in the comments and obviously seeing you back here next week. Until then, toodaloo.